AI spending. Let's make a video on what's really going on with this AI spending. Is it too much? Is it not enough? How could we have a problem when you're spending too much money? If you have a demand problem, I would understand. But a supply problem? On Tuesday, Apple briefly crossed a $5 trillion market value for the first time in history. On that same day, the Nasdaq slid to the edge of a correction and chip stocks got hammered again. Micron was down another 8.8%, AMD down 8%, SanDisk down 14%. Two headlines, same week, same market. And if you want only read one of them, you walk away with completely the wrong picture of what is going on. Because the real story this month is not the stock market at all, it is in the bond market. The cost of insuring the debt of the biggest technology company on earth has quietly gone vertical. Not by a little bit. In some cases, it has tripled in about 18 months. So this is a Black Swan channel, and today we're going to walk you through 4 charts from Apollo that, taken together, ask one enormous question. Will the AI built out pay for itself, and how fast? By the end of the video, you will be able to read every one of those charts. We will have 4 scenarios with probability weights attached, and you will have a practical way to position for all 4. Because the honest answer is that nobody knows which one we get, and the investors who do well from here are the ones who stop trying to guess and start building portfolio that survives being wrong. So before we start, if this is the kind of analysis you want more, hit subscribe. And if you want to become a member, please do so as well on the Patreon channel, as we have 10 separate tools for you. It's also available on YouTube, but it's more practical for me to communicate with you on Patreon. Let's get into it. First of all, what just happened, right? The Federal Reserve is meeting today. Markets expect rates to stay at 3.5 to 3.75%, but roughly 30% of traders are pricing in a hike. Not a cut, a hike. The 10-year Treasury sits around 4.63%. The 30-year is above 5.1%. Oil jumped more than 3% overnight because of what's going on in the Middle East. Alphabet reported last week. It told the market it now plans to spend $195 to $205 billion this week, up from a previous range of 180 to 190. Its cloud business is accelerating nicely. Its free cash flow went negative. The stock fell more than 7%. And on Monday, Apple's chief economist said something on CNBC that I want you to hold on for the next 13 minutes. He estimates that roughly 1 percentage point of U.S. consumer growth right now is coming from AI spending. In a normal 2% year, that is half of all the growth of the entire economy. Half. So this stopped being a technology story a while ago. It is now the economy story, which is exactly why the bond market's opinion matters more here than any analyst price target. Because bond investors do not get paid for upside. They only get paid if they get their money back. They are the most paranoid people in finance. I know it because I was one of those. And paranoid people notice things first. They have started to notice something. Take a look at this chart. Look at the shape, right? From early 2024 all the way to 2025, this chart is boring. Basically, each line that you're seeing is one company. The vertical axis is the annual cost and basis cost of buying 5 years of insurance against that company failing to pay its debt. 100 basis points equal 1%. So a reading of 40 means it costs $400,000 a year to insure $10 million of that company's debt. So basically, you get to collect if the company files for bankruptcy or it is not able to make its interest payment. So lines going up means the market thinks risk is rising because it costs more money to insure that particular name. Lines going down means the market is relaxing. That is the whole chart. The dashed line at 40 is a market, is what used to be the normal ceiling for this group. So let's look at the shape. So look at, for example, Tesla sits in a tight band between 10 and 40 basis points, right? That's boring. That is what the market charging you almost nothing looks like, right? These companies were treated quite reasonably as safer than most governments. Look on the left. See all of them together, bounced up together? They had enormous cash piles, almost no debt, and businesses that printed money. Then look at what happened from roughly November of 2025 onward. The whole chart shifts, at once. Apple, the calmest, cheapest credit in the group, the one that sat at 10 to 12 basis points for 2 solids in the year, is now near 37. This is roughly a tripling, right? It's roughly, Meta has gone from about 22 basis points in early 25 to the low 90s. Microsoft, which was one of the tightest names on the board, has spiked sharply in the last few weeks. Tesla is back above 105, its highest level since the start of 2024. And here's the important part, and I want you to be careful with the language. These are not distress levels. Not remotely. Companies in genuine trouble trades at 4, 6, or 1,000 basis points. What we're looking at is a repricing, not a panic. The market is not saying these companies might fail. It is saying these companies are no longer risk-free, and we would like to be paid something for that. Historically, that is a familiar pattern. Every great capital built out in history, the railways in the 70s, 1870s, the utilities in the 20s, the telecom in the late 90s started with equity enthusiasm and ended with a credit conversion. The equity market asks, how big can this get? The credit market asks, who is holding the bag if it lasts longer than you said? And the second question arrives second. It has just arrived. So, who's paying the bill? So each bar is 1 calendar year. The height is the combined capital spending of Amazon, Alphabet, Meta, and Microsoft, which means data centers, chips, power, networking. The gold bars are guidance and estimates for 2026 and 2027. Okay? And we're in billions of dollars. So this is the bill. These four companies spent about $226 billion between them in 2025. They spent $400 billion, and this year they have got it to around $725 billion, 77% jump. Analysts already model more than $1 trillion for next year. To put $725 billion in perspective, that is more than the entire annual economic output of Switzerland, spent by 4 companies in one bet in 1 year. So question number 2, how is all of this being financed and at what spread? Well, there's 2 panels that you're seeing, both in billions of dollars. On the left, how much money the big cloud company raised by selling their own bonds. And on the right, the total amount of debt issued across the whole AI ecosystem. The cloud giants plus data center developers, power projects, and private credit deals. So for years, the big 4 barely borrowed. Well, you could see on the left. And between 2024, they average about $28 billion of bonds a year, and mostly for tax reasons rather than need. And in 2025, that jumped to roughly $121 billion, more than 4 times the average. And on the right, the ecosystem number, Goldman Sachs counts about $320 billion of AI-related debt issued in 2025 and roughly $489 already issued this year. And we are only in July, and Morgan Stanley thinks the full year number lands near $570 billion. Now, the spread part of the question, which is a bit more interesting, I would say, right? Which most commentary actually skips, the spread is the extra yield the borrower pays above a government bond. It is the market price for doubt. And here's what has changed. Amazon sold $25 billion of bond this month, and now to offer 18 to 21 extra basis points on its longest maturities. Orders come in about 2.5 times the deal size, down from 3 times in March. According to Apollo's own measure of how oversubscribed these deals are, has fallen from roughly 5 times to around 2 times. Maybe there's a bit of indigestion going on here. So that's a number to watch, not the spread itself, the demand for the paper. Spreads tell you where you are. Orders book tell you where you're going. So basically what's happening with these guys, they're spending more money. That's a fact. And they're financing for more. That's a fact. It's costing more. It's a fact. And not as many people want to get in on it. And that's also a fact. And the cost of that protection is going up. Now but this is where education becomes important, so you don't panic and you have a notion of risk. Still, right, they were very cheap, and now they're 100 basis points. But still, we're not at 4, 5, 6, or 2,000 for airlines and for leveraged companies. So the risk is still very much manageable. Okay? The risk of the AI firms, right? So at the end of the day, what we're saying is they are spending more and more money and they're borrowing more and more money. But right now, they're just fine. Keep that in mind. So next, what we want to do is to show you the J curve, right? So each bar is a combined free cash flow of Alphabet, Meta, Microsoft, and Amazon for 1 year. Free cash flow is simply the cash left over after a company has paid all of its bills and all of its investments. It is the money that can actually be returned to you as a shareholder. The dashed line, between those two, what you're seeing, those two bar charts, splits reported history from forecasts. So historical, we're on the left, and forecast, we're on the right. Everything to the right of it is what analysts expect, not what has happened. So the chart is the entire bull case in one picture, and it's worth saying out loud what it assumes, right? It says that cash flow collapses in 26 and 27, as you could see, while the money goes into the ground and then it comes roaring back, more than tripling from the trough by 2028 and reaching new records by 2030. It's a classic J curve. You dig the hole, then you climb out of it higher than when you started. The collapse half is already confirmed. Alphabet free cash flow was $73 billion in 2025 and is heading towards single digit this year. Amazon trading free cash flow has fallen from roughly $38 billion to about $1.2 billion, and the street models somewhere between negative 17 to negative 28. Epoch's AI's work shows that operating cash flow across these firms growing at about 23% a year, while capital spending grows at about 70%. That crossing is happening right now. So question 1 and 4, will the capex pay off? And what if it takes longer than consensus assumes? Now here's my honest read. The payoff is real. The demand signals are not fake. Microsoft has spent $80 billion in backlog of orders it physically cannot serve because it lacks power. Microsoft has $80 billion in backlog. That's money that they're ready to spend. But that they're willing to this is money that's going to come in if they provide the service, but they can't do it. AWS backlog is up 40%. Google Cloud's backlog is about $460 billion. This is not a demand problem. That is a supply problem, and supply problems get solved. The risk is not whether, it is when. And the timing risk is asymmetric in a very specific way. The spending is contracted and the depreciation is scheduled. But the revenue is not. If the cash comes in 2029 instead of 2028, the interest still gets paid on time. The depreciation still hits margin on time, and the debt still matures on time. A 1-year delay is not a 12 months of patience. It is 12 months of carrying costs against no offsetting revenue. That is the mechanism to understand. If you're getting value from this, takes 2 seconds, and don't forget to subscribe and give me the thumbs up. I need to get attention from the algorithm. Is not really liking me too much lately. Next, let's take a look at, will demand for compute be unlimited? So token, as you could see, is roughly a word fragment, the basic unit of AI usage. The bar shows how many trillion tokens per month ran through the world's top 20 AI models, split by where the models was built. Green is in China, gold is in the United States, right? So you could see, look at the raw growth first, because this is the good news and it gets buried. Total usage across the top 20 models went from 83 trillion tokens in May to roughly 151, 46 plus 37 and 98 plus 53. In 1 month, demand for compute is not slowing, it's compounding. So the answer to the question is no, demand is not peaking, not yet, and probably not soon. But look at where the growth went, right? Chinese built models more than doubled from 46 trillion to 98 trillion tokens. American models went from 37 to 53. China took most of the incremental volume. Look at this chart, right? Each bar is a snapshot in time, always adding to 50. The 50 most used AI models in the world. The colors split them by country of origin, and you're watching the composition change, not the total. In January 2025, 5 of the world's 50 most used models were Chinese. By May, that number is around 24 times the share in 16 months. And this is the part that matters for the capex question. Open weight Chinese model priced 60 to 90% below the leading US models. DeepSeek cheapest tier list around 14 cents per million input tokens against several dollars for US flagship. So Here's the uncomfortable arithmetic. Usage can quadruple while revenue per unit of usage collapses. Volume is not the same thing as profit. That is a real threat to the J curve, not a demand cliff, a price cliff. The bull case needs both volume growth and pricing power, and right now it clearly has the first, the second is under attack. The constructive read, right, the premium lane is holding. The most capable US models still capture a huge disproportionate share of actual dollar spent because the highest value work, reasoning, agents, anything where being wrong is expensive, still goes to the best model available. The market is splitting into a commodity lane and a premium lane. Owning the premium lane is a perfectly good business. It's just a smaller one than we own everything. So what we're really saying here is that, yes, so you've got the capex issue, right? You're spending more and more money. Fine. You're going to lose some money, obviously, because of the cash flow situation. But then eventually the money you spend, you recover. And then that's the idea of capex spending. And then at the same time, yeah, there's huge demand for your products. Great. Everybody wants AI. It's fantastic. But China now is getting into the fray. And they're getting more and more important in the AI game. And they are cheaper, a lot cheaper. That's the problem. What if people start switching to the Chinese models? Well, you've developed the US one. It basically what you're looking at is a lot of uncertainty is not something people like after a while, especially when you are fragile. Remember a couple of months ago I told you about fragility? That's what happened when you're fragile. You can't take the heat. So finally, let's take a look at the 4 roads ahead. Each dashed line is one possible future for the average cost of insuring big tech debt. Starting from today's level of roughly 63 basis points, the percentage are my own subjective probability weights, by the way. So basically, if you look at the first base case at 45%, right, the payoff arrives roughly on schedule in 2028. Spreads drift wider through 27 as a cash flow deepens. The cash flow draw deepens and peaking somewhere in the 80s and then settle back near 70. Equities go sideways to choppy while violent rotation between names. Uncomfortable, not dangerous. Then you got a bull case at 20%. Monetization surprise early, right? And maybe there's enterprise agents actually stake. Cloud backlogs convert faster than model. And one or two of these firms shown a general inflection in 27 rather than 28. They're making money sooner. The bear case is the payoff slips to 2029 and beyond. It's taking them longer to break even. And of course, the black swan impact, 10%. Financing stops rather than slows. Order books that went from 5 times cover to 2 times go under 1. Nobody wants to finance these guys. Fast, violent, and over quickly, it is also historically where the best long-term entry point get created. So what do you do from here? Well, what you should do? Well, first of all, watch the order book, not the headline. 2, separate the toll takers from the toll players, right? The company spending the money, the company selling them the equipment, and the companies that benefit from cheap AI without spending a cent. The software, services, industrial firms whose margins improve because interference got 90% cheaper. That third group has been the forgotten trade of 2026. Falling token prices are terrible for one group and outstanding for another. 3, use the barbell. Make sure you've got cash just in case you're wrong so you could take advantage of some very, very cheap money-making stocks. 4, own some credit exposure, not just equity. If spreads go wider, bonds become very much interesting. So at the end, I will say this. If this helps you and you see the picture more deeply, clearly, subscribe to the Black Swan channel. And click the bell because the next 3 earnings reports are going to move this story fast. And if you want to know more and want to do more and want to understand more and be more secured in your portfolio, join me in my Patreon channel and as a member, as I will come to you up to 10 times with 10 times the amount of tools for you to manage and understand what is going on. See you soon.